From the morning reading, long-tailed hammer on the SPX, SPY, diamonds, QQQ, near August support indicate possible bottom, protect bearish profits. All 9 sectors moved lower on Monday. XLP, XLU, and XLE were the strongest sectors, while XLB was the weakest sector. Oil fell 88 cents to close at $30.12. Breadth was mixed as decliners led advancers 3.96 to 1 on the New York Stock Exchange and 2.45 to 1 on the NASDAQ. The SPX, SPY, diamonds, and QQQ all formed a hammer candle near August support, indicating that institutions may be accumulating stock at support for the 4th time since late August. SPY broke the 187.06 support on the open, putting the traders in the defensive posture. With the formation of a bullish hammer or other bullish candles, stops should be moved above today's bullish candles to protect profits on bearish trades in the event that a follow-through bounce occurs on Tuesday. Active investment managers are not only underexposed to stocks, they're confident about it. This week, the average manager was only 22% exposed to stocks, the lowest level since September. Even more notably, there was a heavy dose of groupthink among the managers, as the variability amongst their responses was amongst the lowest since 2006. Investors yanked money out of mutual funds and ETFs again this week. That makes 10 weeks of outflow over the past 12 weeks. The total outflow over those 12 weeks is nearly the most since 2003, though it's a percentage of total assets that has been eclipsed a couple of times. Traders have moved more than $750 million into the main gold fund, GLD, over the past week. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:45 a.m. Central Time, and I'm recording this in preparation for the market day of February the 9th, 2016. Remember that on YouTube, you can have a free subscription to the channel and be alerted to new content being published. Give the video a few minutes after being published for the video to be available in high definition. Click on the setting button to choose the high def playback level. In this same area, you can also control the speed of the playback. I routinely find that I can fully understand videos at about 1.5x the recorded speed. Full disclosures are available at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and get into the morning report. And the overnight action, a little bit weak, though not as weak as it once was last night. S&P futures are down about 0.25%. Russell futures down just marginally, as are the NASDAQ futures. Dow futures are down a little more than 0.25%. Crude oil's up 2.36%. Euros essentially scratch. Bonds are down about 0.33%, and gold is down about 0.75%. China and Hong Kong, you'll notice the day here 2.5, they're on trade holiday, so there's no actual activity overnight here. In Japan, they were open, they're down 5.4%. Germany's up marginally, and United Kingdom's up about 0.25%. In terms of macroeconomic reports for today in the United States, it's pretty light, just the JOLTS job openings. And looking forward towards tomorrow, we see Fed Chair Yellen speaking. And we also have the weekly crude oil inventories and the 10-year bond auction. So that looks to be about it on that. In terms of current volatility conditions, VIX, of course, up to 26.40, though the skew remains relatively benign, and IV percentile remains kind of in the middle range, with a 44 in the S&P, 56 on the Russell, 61 on the NASDAQ, and 56 on the Dow. We did have a standard deviation move put in on the S&P yesterday, though a couple indices were also close, but only the S&P actually went over the 1 standard deviation threshold to be included on this report. In terms of the current charts, I've gone and put in a little bit more time here in order to go back and see where this support is coming from. There's actually, and even further back, there's a couple support lines that come into this area that match up with the support that we have from January on that swing low. And you see that this action yesterday did kind of come down into this area before reversing. We had a pretty significant candle. Let's go ahead and zoom in a little bit more to more recent action. So bottom line, this area between, well, yesterday's swing low at about 1827 on the SPX and about 1813 and probably 1800. So you got about, we'll call it about a 25 point range there. That would be a key support area, and things could turn anywhere in that area should we revisit that. Now yesterday, of course, we had a gap down, went way down, and then reversed over half of that drop to end up with I'm not sure I'd call that a hammer, but I guess it has the essence and feel of a hammer. Fairly large body to be probably called a hammer technically. Certainly it's a bullish-like candle in that you had this rejection. And this rejection came from an area where we might expect that rejection. We need to respect that support and institutional willingness to purchase assets are existing in this area. So if you have bearish trades on, you might want to be tightening up those stops and then kind of taking profits at what makes sense to take until we clear this area. Should we clear this area, then there frankly is a lot of open air, and we're probably heading to the SPX 1750 at that point. But that's an area that needs to be respected. So while we've been so weak for so long, and the expectation perhaps is that we eventually get there, this is a pretty good little speed bump along the way, so respect that. In terms of the other markets, and before we do that, let's go look at the ES. And I want you to see just what happened in the overnight. So we did have some weakness that came down towards the prior lows from yesterday, though not all the way, and then has reversed some. But you see it is down, and that's actually growing as we speak. We're down over 10 points right now. So again, a lot of weakness in this market, but we also, from a pot odds standpoint, kind of hard to initiate a new position right now unless you're an intraday trader and you're going for pretty small targets, because our likely targets would need to exit somewhere between this 1820, 1800 area. So just kind of keep that in mind. Versus if we were to have a rally, there's a lot of overhead area to where we could run all the way back up to this swing high area. So pot odds actually aren't real good right now for initiation of a new position, and yet at the same time taking that bullish position would be a counter trend trade, and counter trend trading is never generally a good idea for anybody other than really experienced traders. Let's go to the NASDAQ, and you see the action here, big gap. This is, obviously we're coming back towards those August lows, and we've broken the recent lows. So pretty weak there. And indeed, if we look at the futures contract, our weakness continues. Look at that yesterday. So that futures contract yesterday undercut the August lows. That's the first time that's happened, obviously, since August. These prior lows, managed to return to the bull side before getting quite that low. So NASDAQ has had a significant breakdown in the last few days, and the Russell just continues to just melt. And you see this recent action here, and again yesterday, a reversal right near the January lows, undercut it just by a handful of ticks, and again weakness right now. In terms of the ETF, you look at this, just about as ugly as it gets. And then, let's see here, the Dow. Okay, so this similar to the S&P, where you have this area that is similar to the August lows that seems to be coming in as some support. So you've got an area down there very much like S&P. The 30-year bond, just absolute breakout. Look at this. I mean, this is quite a move for bonds. Everybody's thinking is that bonds are going to be toast in 2016 with the Fed raising interest rates. Well, you know, bonds serve several purposes, and one is a flight to safety. And this is clearly that flight to safety, even in the face of potential concerns of the Fed unwind. The yields and the way bonds are moving right now are more of a reflection of other forces that are dominating any concern about what the Fed might do. And in overnight, we actually had a new 52-week high. And let's see here where this might go. Wow. I mean, this goes quite a ways back. So we have cut up over this set of highs that were formed back in March of 2015, the last time the bonds were such a tear. So now big overnight reversal here, but still this continues to really pressure the all-time highs. And you see TLT has some more room to run to get up to its 52-week highs, but still yesterday was a big breakaway gap, breakthrough the horizontal resistance, and big green candle there. So I think that's probably enough on the charts. Let's go back to our daily report, and we do have new developments here. We have, with the portfolio investor posture, we have deteriorated all the way back to market in correction. So that is as weak as it gets. You put that along with the phase one from the market trend intermediate term phase opinion, which is looking for bear flags, is the basic description to that. Accumulation distribution score, a very weak D-, as is the NASDAQ, also D-. GMI index retains at 0 out of 6 rating and a sell signal since 1210. That author happily in cash. Stock charts decision points remain no change from yesterday there, but remain very weak. We do have a change in the position sizing opinions with that market and correction signal. The buy long side portfolio exposure now goes to 0%. And also from a volatility, that one also changed. Our VIX went up into the next band yesterday. So position sizing, according to that opinion, would be now less than 50%. So this is getting just about as low as these mechanical signals come in. If the VIX goes over 30, that would also go to flat. In terms of the intermediate term market posture, very bearish with a very bearish sentiment line. And you see here the S&P down below 30 and slope down. So no new short-term bullish trades or no new intermediate term bullish trades until we get a confirmed bottom and turn. And you see the others, the Dow, just over 30. It's been holding up just a little bit better than the others. Of course, the Dow made up of 30 large cap stocks, more often used for more defensive postures because of their dividend structure and their very diversified nature. But you see the higher beta stuff, NASDAQ and Russell, both below 20 into the severely bearish area. Hedge warning status has gone up to a 2+. So really there's only half an increment here to go to the highest level of hedge warning. And that frankly would happen if we were to break that 1800 area on the SPX. In terms of specific metrics, you can see volatility, market in decline, sharp increase warning, VIX futures up over 18, distribution day count now reset with the market in correction. VIX phase increasing. Current week out expected move, the SPX, this has gone up since yesterday's action and now is a 66. So very, very high. We have, with yesterday's new highs, new lows, even with that reversal, there were 584 new lows put in for the month yesterday. All 5 key intermarket risk aversion indicators now are flagging as risk off. So that should say something to you as well. In terms of sentiment, our sentiment indicators, short-term risk of 5, medium-term risk of 4, so relatively benign there. We have had a bit of a washout with yesterday's action, so potential to ebb off some of that fear there. And fear and greed index, we now have, we're a new low for recent action, back down to a 15 in the extreme fear area, and you see how this has been dropping in recent trading days. In terms of special opinions, no changes from yesterday. Option income strategies, the VIX is outside the acceptable window to initiate new positions for novice traders, though aggressive traders may take advantage, though it would be highly advisable to reduce position size because your probability of making adjustments is very, very high given the current market conditions. So large delta, large vega moves to impact your option income strategies. Covered call and put selling, not acceptable to initiate new positions for novice traders. More aggressive traders should be using a range of these very defensive structures that are mentioned here. In terms of sector specific, it's a sea of red with only utilities holding up, transportation perhaps a little bit, but very, very, very poor market structure in all these market postures in all these sectors across all these time frames. And you see in the percent change yesterday, only energy squeaked out positive yesterday. Even utilities was giving up some of its recent gains, though it's been something of a parabolic move of late. And you see the 1 month up over 7.5%. And telecom, also a defensive area, was also up over 10% in the 1 month period. So even those defensive sectors will go down in weekdays, and even they will give it up after going parabolic, as has been the recent action. Let's see here. I think that's probably enough for today. Let's go on to mention a couple things here. If you'd like to get emails from us, we send out a limited number of emails, but particularly when we want to send out an alert about a hedge risk level change, and then periodic blog articles. I sent out an email yesterday, very interesting. I quoted from an author that I follow talking about market timing and the like. So once in a while, those will go out. If you'd like to be able to get those, just go to this website at the link here, scroll down the page just a little bit, find this button, click on that button, put your name and email address there. And when you do that, you'll also receive a copy, a hyperlink to get a copy of the ebook Portfolio Strategy. And that's a pretty neat little ebook there. You can also use your smartphone. Just send or text Falcon Global, all one word, to the number indicated, and that will do the same thing for you. And then I'll just go ahead and scroll through the rest of this today, and just hit the pause button if you need to get a hyperlink and go to get more details on some of these other products or services that are available from Falcon Global. Disclaimers as always, hit the pause button if you need more time to review. Obviously, we are not your broker, CTA, or registered advisor. We have no fiduciary responsibility. We do not know your financial situation. If you need to see the full disclosures, you can go to the hyperlink that's down here at the bottom, and that'll give you everything that you need to know. We'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.